We are now going to go through the purchasing cycle, or how do we buy stuff to then resell. And this is called our inventory. So how do we actually get our inventory into our store? What are the journal entries associated with it? So first of all, the first thing that you're probably doing is you're buying something from a supplier. And generally, in the business world, we don't pay cash for these things. Of course, we could pay cash, but usually we buy it on account and then they bill us later. So that's the example that we're going to use, is we're purchasing, for example, $1,000 worth of inventory on account. So we have $1,000 of inventory that we purchase on account. And so that's kind of what it will look like in the homework problems. Is when you see the term on account, that usually means accounts receivable or accounts payable. In this case, we're the ones doing the paying, so this is going to be accounts payable. All right, so the first thing that happens in the journal entry is we have inventory coming in. And inventory is an asset. So to make an asset go up, we have to debit the asset. So in this case, we have inventory being debited $1,000. And we also owe more money. That sounds like a liability, and we're going to put this in accounts payable. This is the most common use of accounts payable for a merchandiser, is buying inventory. All right, so we have the inventory. We put it into accounts payable, showing that we owe $1,000. Now, when we get the bill from the supplier and pay it off, well, our accounts payable will go down. So we debit accounts payable and we will credit cash. All right, so that's the very simple cycle, that we buy inventory on account and then we pay off that account. Let's make it a little bit more complicated now. Let's throw in a return. So let's say the same thing happened here. So we purchased, let's say we purchased $2,000 worth of inventory. And it is, again, on account. But when we get the inventory, some of it isn't right. So it might be damaged, it might be something, maybe they screwed up our order, it's the wrong color, whatever it is, and we send it back to our supplier. So in that case, we no longer have $2,000 in inventory, so we need to credit inventory for how much we sent back. In this case, let's say we sent back $500 of the inventory. For some reason, again, maybe it's the wrong color or messed up our order or it's damaged, whatever the reason, we returned it. So our inventory goes down $500 because we no longer have it. The other thing that happens is, well, we also no longer owe $2,000. So we only owe $1,500. So we also need to make accounts payable go down $500. So if we're looking at our accounts payable, we want to make sure that it's showing that we only owe $1,500. So we credited $2,000, then we debited $500, and so indeed the balance at the end of the day is $1,500. So now when it comes time to pay off the bill that the supplier sends us, we will debit accounts payable for the $1,500 that we owe and credit cash. And I think I've run out of room on the screen here, but so we credited cash for $1,500. All right, so this is just a regular purchase over here with nothing fancy or special. This is if we had some sort of return. And obviously, this is a return before we actually paid the bill. If we return the inventory after we pay the bill, then they will probably be giving us cash instead of credit on our bill that they send us. So Either way, you might have to look at it, but this is the most likely pattern that you'll see in the homework, where we get the inventory, we return some of it, and then we pay off the remainder of the bill. All right, so let's keep going here. What we have next is, what if we have a discount? So what if it's a purchase discount? So we just talked about terms in a previous video. And let's say we buy this $1,000. Let's go back to $1,000 of inventory. So we buy $1,000 of inventory. So we get the $1,000 and we owe the $1,000. However, they have given us terms of 210 net 30. And as we discussed in the previous video, we'd kind of be foolish not to pay the discount or not to take the discount if we can, right? So if we have the cash, we'd be foolish not to take the discount within those first 10 days. So us being not foolish business people, we are going to pay within the 10 days. And that means, well, instead of paying $1,000, we are going to get a $20 discount. So we are actually only going to pay $980. All right, there are two ways of looking at this. I'm going to first do this in multiple steps, and then we are going to combine that into one step that your homework probably wants you to do. So the first thing is, my first step is, well, let's say I now no longer owe that $20. And in that case, I don't owe the $20. So I am going to debit accounts payable for the $20 that I do not owe. The other step, the other part of this journal entry would be, well, my inventory is also going down $20. Now, why is inventory going down? Well, what should be in the inventory account? It should be what we paid for it. This is also a variation of the cost principle, or it's an example of the cost principle, that we record things at what it cost us. And in this case, what did the inventory cost us? It didn't actually cost us $1,000. We're not paying $1,000 for the inventory. We're only paying $980. So we need to take out the $20 from the $1,000 so that we are following the cost principle in accounting. And then we can actually pay off the bill. So in this case, we'd pay off the other $980 and credit cash. All right, so hopefully that makes sense. Right now I have it in two parts right here. So first part is I am going to update my accounts payable, my inventory for the discount. So I debit accounts payable for the 20 and credit inventory for the 20 to update what I actually am paying and what I actually owe. And then I will pay off the accounts payable. All right, so if you're doing your homework though, your homework is not going to like this because it wants it all in one journal entry instead of two. So how do we combine these two journal entries into one? Whenever you are combining journal entries, like mathematics, you want to combine like terms. So right now, the only like term I have is accounts payable. So I have a debit to accounts payable of 20 and a debit to accounts payable of 980. Well, that's two debits. So that's kind of like, well, it is exactly like debiting accounts payable for 1,000. Inventory, right now, I only have one of those, so I'm just going to bring that right on over. And cash, I only have one of those as well, so I'm going to bring that over as well. So I combined these two journal entries by combining the accounts that were the same. So in this case, I had 2 debits to accounts payable that I combined into one. The other 2 accounts, the inventory and the cash, were the only ones in the journal entries. So I just brought those ones over exactly how they were. So this is what your homework is going to want. Your homework is going to want it in 1 journal entry instead of 2. The other way you can look at this is instead of thinking of it as 2 different steps, you can think of it as 1 step. The first step is figuring out how much cash you are paying. In this case, I am paying $980 in cash. So I will credit cash $980. I am going to debit accounts payable by looking at what is in my accounts payable account. Right now I have $1,000 in accounts payable. How much of that am I paying off? I am paying off all of it. By the end of this journal entry, I want to show that I don't owe anything. So my goal is to get this down to 0. How do I get it down to 0? I must have to debit accounts payable by 1,000. So that's where this one comes in. And then I have a $20 difference. Where does it go? It has to go to inventory to update inventory for what I actually paid for it. So there are 2 different ways of looking at this. One is the 2-step process saying, all right, let's update accounts payable and inventory for what I'm actually paying, and then paying off the accounts payable. And then to get the homework right, combine those 2 into 1 journal entry. And then the other way of looking at it is just beginning with 1 journal entry from the beginning, saying I'm paying off all of my accounts payable. How much is that? How much cash am I actually paying? The difference goes to inventory. All right, so 2 different ways of looking at those discounts and how to do it. All right, let's make this just slightly more complicated, and let's do one more example problem here. Let's combine our returns and our discounts. All right, so let's go with the example that we owed or we purchased $2,000 in inventory. Ooh. So I debit inventory $2,000 and then I credit my accounts payable $2,000. All right, so but they have given me terms of 210 net 30, which means if I pay within the 10 days, I will get a 20% discount, which in this case would be $40 off. So 2% of $2,000 is $40. However, when I get the inventory, I notice that some of it is damaged, wrong color, whatever. So I send $500 of it back. So now I have to do a purchase return, which means we did this kind of journal entry already, but I am returning $500 in inventory, and I am taking $500 off the bill that I owe the supplier. So I reduce accounts payable $500, reduce inventory $500. And then still within the discount period, still within that 10 days, I pay off what's left. Now the question is, well, what is left? I'm now calculating 2% off of what number? Well, it's what I actually owe, which is no longer $2,000. So I used to owe $2,000. I don't anymore. I only owe $1,500. So I'm going to take the 2% off of the $1,500, which means I'm getting $30 off now instead. All right, so let's do the 1 journal entry approach here. Instead of thinking about it in 2 steps, how much of my accounts payable am I paying off? I'm paying off the full amount that I owe, and our accounting records show that I owe $1,500. So I'm paying off all of it. How much cash am I paying? Well, I said, well, I'm getting $30 off, so I'm only paying $1,470. I have a $30 difference. where does that go? It goes to inventory. And before we end this video, let's look at what's in the inventory account and just make sure it follows the cost principle. I started off with 2,000 there. I returned 500, which gave me $1,500 of inventory. But then in the end, I didn't actually pay $1,500 for it. I took off 30, and so I have $1,470 in the inventory account, which matches what I actually paid for my inventory, and therefore it follows the cost principle. All right, so there's an overview of the purchasing process. We have our regular purchases, paying off those purchases. What if we return stuff? And then what if there's a discount involved, and how do I account for all of that?